The Great Depression and the 1929 stock market crash are lessons in how economic risks can build up and spiral into disaster. In the 1920s, the U.S. economy seemed unstoppable, new industries were booming, and everyday Americans were enjoying products like cars, radios, and appliances made more affordable by mass production methods like Ford's assembly line. People began to buy goods on credit, which allowed them to pay over time, encouraging even more spending. Advertising also took off, pushing a culture where having the latest products meant a better life. Many Americans saw the stock market as a quick way to grow wealth, leading people from all walks of life to invest heavily, often on credit. They'd buy stocks on margin, borrowing money to buy shares, sometimes only putting down a small percentage. This borrowing created an inflated demand for stocks, making prices skyrocket without the real value to back it up, creating a fragile system dependent on prices rising forever. Underneath this surface of wealth, however, were some serious problems. The gap between the rich and average workers was huge, with many people barely making enough to get by. Business growth was already slowing, and consumer demand couldn't keep up with all the goods being produced. High tariffs also hurt international trade, making it hard for U.S. companies to sell products overseas. Banks, meanwhile, were giving out too many risky loans, including to people borrowing to buy stocks. If the stock market fell, these banks would be left with bad loans they couldn't recover, putting depositors' money at risk. Despite these warning signs, people kept pouring money into the market, believing prices would only go up. The crash came suddenly and hit hard, starting on October 24, 1929, or Black Thursday. Investors began selling their stocks in panic as fears of a downturn grew. Even though big banks tried to calm the market by buying up stocks, the panic only grew. By Black Tuesday on October 29th, the market saw a massive sell-off, wiping out billions in a matter of hours. People who had bought stocks on margin were now in deep debt, unable to repay the money they borrowed. The collapse shook the financial world and marked the end of the 1920s prosperity. After the crash, chaos spread quickly. Banks, which had used their customers' deposits for risky investments, faced a crisis as people rushed to pull out their savings, causing many banks to shut down. Businesses saw their sales plummet as consumer confidence dropped. To cope, companies cut jobs and slashed production, causing unemployment to skyrocket. Rural areas were especially hard hit as farmers, already dealing with low crop prices, were now unable to pay their debts and lost their farms to foreclosure. This sparked a destructive cycle, with people forced to sell off what they owned to cover debts, driving prices down even further, reducing the value of businesses and individual wealth. The crash marked the beginning of the Great Depression, a decade of extreme economic hardship. By 1933, unemployment reached a staggering 25%, meaning 1 in 4 Americans was out of work. Poverty spread across the country, with Hoovervilles, makeshift shantytowns named after President Hoover, springing up to house those left homeless. Soup kitchens and bread lines became symbols of the time, with millions struggling just to survive. International trade collapsed as countries raised tariffs to protect their own economies, making things even worse worldwide. In response to the crisis, President Franklin D. Roosevelt launched the New Deal in 1933. This set of programs was designed to get people back to work, provide financial security, and restore hope. The New Deal created jobs through public projects like roads, parks, and schools, employing millions. The government also introduced the FDIC to protect bank deposits and the SEC to regulate the stock market, making it safer for ordinary people to invest. Social Security and unemployment insurance were established to give Americans a safety net in tough times, fundamentally changing the role of government in the economy. The 1929 crash and the Great Depression left a powerful legacy. They showed the risks of unchecked speculation, the importance of fair wealth distribution, and the need for government regulation to prevent such a crisis from happening again. Today, these events remind us that economic booms can create the illusion of endless prosperity, but if built on too much debt and speculation, they are bound to fail. Understanding this history helps us see similar risks today, where issues like income inequality, market bubbles, and high levels of debt can still threaten stability. The Great Depression remains a clear warning about the need for caution, fairness, and regulation to keep the economy strong and balanced.